What is the real determining factor of what interest rate someone could get when they're buying a home? And should I be really concerned and maybe put off buying a home because the Fed has raised their interest rates? I'd like to know that.
When I'm asked about what determines mortgage rates, the first thing I suggest is don't focus too much on the Fed. The reason is the Federal Reserve does not directly control fixed rate mortgage rates. The rate that they adjust from time to time is the federal funds rate. That's for short-term overnight borrowing among member banks of the Federal Reserve System. What it does directly correlate to is certain types of loans, such as home equity lines of credit or credit cards, because those are tied to the prime rate, which is tied to the Fed funds rate. The other issue about the focus on the Fed is it makes people believe that the mortgage interest rate market is relatively static, that interest rates for mortgages only change from time to time when the Fed makes their announcement. That's not how the market works. Mortgages are primarily used as collateral for securities, for bonds. You may have heard the term mortgage-backed securities or mortgage-backed bonds. So that means most mortgages will serve as collateral for that type of financial investment, and therefore it's the bond market that has a more direct correlation to what's happening with mortgages. I always suggest to follow the 10-year U.S. Treasury bond yield. You can pull up a chart on that any day. As you see that yield move up and down, that gives you a very direct clue of the direction of mortgage rates. And what's interesting is with the Fed's recent announcement of a 0.75% increase in the Fed funds rate, the belief that mortgage rates have followed suit hasn't been true. Mortgage rates are actually better than the announcement. And that's a reason, therefore, you should not let the Federal Reserve announcements from time to time keep you from pursuing a home purchase sooner than later. In fact, now is a great time to take advantage of the dip in rates where we're back under 5%.